CPI numbers have trickled in, and it is hotter than what we were penciling in. In fact, the June CPI combined inflation rate is at 5.08% versus 4.80% in the month of May. We were expecting it to be somewhere to remain below the 5% mark. Also, the food inflation has risen at 9.36% versus 8.69% in the month of May. But to tell you what, Saugata Bhattacharya, who's the Independent Economist, and Kanika Pasricha, who's the Chief Economic Advisor of Union Bank of India, are joining us to weigh in on the data. Hi, welcome to News Now. Saugata, I'll come to you first. Tell us the numbers. CPI numbers are in. The inflation is hotter than what we were penciling in. We were penciling in somewhere below the 5% mark, but the numbers have trickled in, and it is hotter than what we were expecting. Do tell us, how do you look at these numbers, the first snapshot of the numbers?
Hi, thank you for having me on your show. Yes, I mean, the inflation numbers are higher than what we had expected. 4.8 was our own estimate, given what we saw of cereals, vegetables, fruits, prices, pulses, etc. So we had thought about 4.8%, instead of which it's come in about 5.1%, which is certainly. We had got an indication of this from Governor Das's interview yesterday, where he said that they were expecting inflation around 5%. But this definitely increases the chances that this quarter's inflation will be hotter than the earlier RBI expectations or RBI forecasts. We need to see what the core inflation is. And we know that during the heat wave, etc., I mean, there have been multiple disruptions. So this is definitely a little notch higher. But overall, inflation still seems to be close to where the RBI is forecasting, 4.5% for the year, or maybe even a little lower than that.
Right, I was coming and going to ask you that only, Saugata, that the RBI's forecast, is that likely to remain, or are they likely to revise this because of this big upside surprise that has come in? Food inflation has also been rather sticky and a point of concern. Do weigh in on that, and of course the expectations of the RBI going forward, and is it likely to remain what the RBI had projected earlier on, or is it likely to now revise?
So given, I think the Q1 numbers will certainly be revised a little bit upwards, say from the earlier 4.5 to about 4.6, etc. But overall, given the fact that the rains still seem to be on track, so we still seem to be on track for a normal monsoon. Sowing has been good. The Rabi season should actually also be fairly normal. And given the fact that global food prices have not increased to the extent that we were worried, I think, and plus the fact that core inflation will probably see about a 3.1 to 3.2% number even for June. And the fact that global commodities prices are also damped a little bit from what we had seen earlier, my own sense is the RBI will not quickly change the overall average of 4.5%, but there still remain a series of risks, particularly from the oil sector, oil prices, crude prices, which we need to monitor very closely.
Right. Kanika, I will come to you then. Let's look at the food inflation here. Now, while Saugata says that, food inflation the world over hasn't risen to, to that level, it has been rather sticky. And even this time round, the food inflation has come in hotter than expected, and the headline inflation is also higher than what we were expecting. How do you see this? Now, we are expecting normal monsoons. IMD has predicted normal monsoons. Going ahead, is that likely to ease out the food inflation?
So, Arpita, see, first and foremost, thanks for having me on the show. In terms of, before coming to food inflation, just one more point. So, for second consecutive month, we are near dot. On dot in terms of our inflation estimate. We were at 5.06, while for this print, the consensus was very wide, between 4.4 to around 5.1%. See, what's very important to note is, within this print, core stays at record low of 3.14. But food inflation is close to 8.3, 8.4%. And you're absolutely right, and I completely agree with what Saugata said. It's not about global food prices, it's more about our own inflation dynamics. Because since November, December last year, we did not see adequate seasonal correction in vegetable prices. And in this print, we look at the data internals, but when we gave the print, we were assuming vegetable sequential momentum of around 17-18% and YOY inflation above 25%. Now, if we just remove that vegetables component itself, though of course there are underlying price pressures in cereals and pulses as well, but if we just remove vegetables, then CPI X vegetables is around 3.3. So this component of inflation, which is volatile, which has seen some upward pressure because monsoons last year were inadequate. It was an El Nino year. Now we are shifting from El Nino to La Nina globally, and that's actually showing up in our monsoon trends as well. So as monsoon normalizes, and we have seen kharif sowing in OPT, onion, potato, tomato actually improve, that itself gives us some confidence that in the coming months, maybe vegetables inflation starts to come down and provide some relief in terms of headline inflation. The other two components, A, cereals, which has seen some upward pressure in terms of momentum. With the stocks improving, wheat harvest was actually quite adequate. That may help. And on pulses side as well, it all depends on how crop sowing is progressing. But for the last week, the latest data we saw, pulses crop sowing up some 55% YOY. Still lower than compared to previous 2 to 3 years, but at least compared to last year, things are improving. So overall, A, food inflation trends need close watch. B, improve monsoon trends providing some relief. But within food inflation in specific, apart from cereals and pulses, vegetables that we are closely watching out for. Thanks.
Right. All right. I'm told that we're also joined by Indranil Pan, who's the Chief Economist, Yes Bank. Hi, Mr. Pan. Thank you so much for joining us today. Mr. Pan, we've been talking about how this inflation has come in hotter than expected. In fact, yesterday, like Saugata mentioned, that even the RBI governor had hinted towards a 5% print, but that's come in hotter than that also. Going forward, how do you see RBI looking at it? What is are they going to revise their targets? Also, the stance on rate cuts, how is that likely to impact that?
Yeah, okay. I think I heard Saugata and Kanika both, and the concerns in terms of the food inflation, which are absolutely there. The issue for the RBI, I think, is more the fact that whether or not they are sort of trying to sort of reaching the 4% line on a sustainable basis. And if you remember, some of the comments that the governor himself had made at the press conference during the last monetary policy meeting, he was very clear about the fact that, yes, the base effects of the last year should be pushing down the Q2 numbers closer to the 4% or maybe slightly even lower. But after that, it goes higher. Now, subsequently, he also sort of been airing the view that if there are vegetable shocks, there are chances that the end year number, or at least the fourth quarter number, is closer to the 5% mark rather than the 4% mark. And that sort of limits any chance from the Reserve Bank of India to actually reduce the interest rates in the economy. Saugata did mention about yesterday's comments from the governor, where there was also a comment in terms of the real rates in the economy. So while it might actually take about 2 more months, is what he said, for the RBI to come out with a report on the real rate or the right real rate in the economy, he also did mention that the RBI may not be purely guided by that, and it's more a theoretical concept, and it's more the real rate also tends to change in terms of the economic conditions that are there. And therefore, the focus, in my opinion, continues to be on inflation and how the inflation trajectory pans out. And that's where I think the RBI will be restrained from doing anything much in terms of the interest rates. Now, after today's print, and also factoring in the 22% odd increase in the vegetables that we see on a year-to-date or a month-to-date basis in July, our sort of inflation average for the year is now coming close to 4.6%. rather than the 4.3, 4.4% that we were looking at before the June data came out, and before we realized that even in July, vegetables are relatively on the stickier side. So that also, as we factor into our model, plus having looked at the expectations model of the households on inflation, which even in the last number did show a 10 basis higher for the 1 year ahead, and also for the 3-month ahead inflation expectations of the household. That's also possibly another reason why I would not expect any sort of rate change from the RBI in the very near term, and possibly there's a rising probability that we don't get a rate change in this financial year.
Right. Mr. Pan, one final question from you. Tell us, what about the rural demand? We started seeing the green shoots in rural demand. Now with food inflation remaining sticky, also though the IMD predicts a normal monsoon, how is this likely to impact rural demand and rural consumption?
I think rural demand, obviously, the higher the food inflation, rather than benefiting the rural economy, it actually hurts the rural economy. Simply because most of the farmers in the rural segment are marginal farmers and small farmers, and a significant amount of farmers today also don't have adequate marketable surplus, which necessarily means that if he has to go to the market to buy all the other sort of stuff that he needs for his daily household needs, the inflation is likely to hurt the rural economy more than sort of impacting it positively. The real income of the rural economy will be also on the lower side, which therefore will impact its discretionary consumption. And therefore, I think, yes, as you rightly said, we were seeing some green shoots in terms of the rural economy. And unless there is a very solid sort of reduction in the food inflation, it could be difficult to see a sustained uptick in the rural economy, especially with respect to the discretionary items. And also, if interest rates continue to remain where they are from an RBI's perspective, there could be little sort of avenue of any reduction in the interest rate that consumers face, and that could also sort of hurt the growth structure of the economy at the margin.
All right. Thank you so much for joining us, Mr. Pan. Saugata and Kanika, thank you so much for joining us and weighing in on the inflation print. Thank you so much.
If you like this video, then like, share and subscribe to ET Now.